Corporate finance practice problem using Excel. Debenture that is callable price calculation. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side will populate that into the blue area on the right-hand side. We're going to have debentures. We're going to calculate the price in a similar way as we've seen with the bonds in the past. So once again, if you want to calculate and focus in on just standard bond calculations and practice present value calculations, take a look at a prior section where we do that in detail. The new thing here is that we have this callable item. What's going to be the impact when we do the calculation of the price or the value, given the fact that they are going to be callable, meaning they could be called back at the price of the 1,300. So we'll do our standard kind of calculation as we would for basically our normal, bond type price calculation for our debt instrument price calculation. We're going to say the face is 1,000, the coupon rate 12%, yield to maturity or market rate 7%, due in 20 years, and we're also going to say it's a semi-annual, and then we have the new component of the callable component. In essence, what we'll do here is we'll calculate basically the value or price without the callable component. And then the callable component will probably be acting on the market as something like a cap, given the fact that it could be called at that point. And if the price goes over and above it, then people are less likely to pay the price over and above if it can be called at any time at that callable amount. We will start off with the standard calculation for the price of the bond. We'll do it relatively quickly. If you want to see more detail about it, take a look at the prior section where we focus in on that in detail. If you want to focus in on present value calculations done in other methods such as tables and mathematical formats rather than the Excel here, we have a section on the present value calculations as well. So we're going to be doing the present value of the interest amounts. The interest would be the 1,000 times the 12% divided by 2 because it's going to be paid semi-annually. Remember that the percents are going to be there as annual amounts. Typically, if there's some period other than an annual amount, we have to do something to it. In this case, divide by 2 to make it a 6-month amount. And then we'll do the present value of the 1, the face amount that will be then received at the end of the 20-year time period. So let's do our calculations. Present value of interest calculation, annuity formula, negative present value, shift 9. The rate is going to be the market rate, the yield to maturity, but that's for a year. So I'm going to divide it by 2 because we're doing the semi-annual thing. And then comma, number of periods. The number of periods would be 20 years, but we're not talking years. We're talking 6-month time periods. So we're going to take that. We're going to multiply it times 2 for 40 periods of 6 months. And then comma, the payment would then be the 1,000 times the 12%, but that would be for a year. We're looking 6-month type payments here, so we're going to divide that then by 2, not 0.2. Closing it up, there we have that. Let's add a couple decimals, number group, couple decimals here. And then we want the present value of the principal, which is the 1,000 that we're going to bring back. So this is the present value of 1 calculation, negative PV shift 9 rate is going to be then the 7% market rate once again, but that's for a year. We'll take that, divide it by 2 for the 6-month time period, comma, number of periods is also, again, 20 if it were yearly, but it's per 6 months, semi-annual, so we'll multiply that times 2 to get to 40, and then comma, this is not an annuity, so we'll say comma again, skipping over to the future value, which will be the face amount, the $1,000. Let's go ahead and add some decimals there. Number group, couple decimals. Let's underline it, put in the line underneath. That's why we call it the underline. There it is, that line right underneath there. And that's going to give us the price of bonds or the value of the bonds given the fact or without the callable component, right? So this is going to then be summing this up. So it would be the 1,534. Let's add a couple decimals. Number group, add a couple decimals. Now, then we would think, okay, well, what's going to be the callable component here? Well, if you're selling these on the market, these are being sold on the market, and they could be called back at any time at the price of the 1,300, then it's unlikely that because this amount is over the 1,300, it's unlikely they're going to sell at that amount if they could be called, if there's a risk they could be called at any time at the 1,300. So you can kind of think of the callable component here as being a cap, meaning if you calculate the bond price without the callable component and it was below then the callable amount, then you would think, okay, the bond price might be the valid calculation that it would go for on the market. However, if you come up to a price that's above the callable amount, you would think about that as possibly being a kind of cap, and it would limit people then to purchase above that. So that's what this basic text box would be here. So you might need to explain that in basically a practice problem or something like that, or have that kind of be the you might see in a multiple choice question if that be where this would be applicable for you.